Good morning. I'm Tim Nyland, and today we are reintroducing the Earnings Certain Core 75 stock portfolio for 2021. Before we get started, please like, comment, and subscribe, and come back every week for more videos on investing strategy and making the most of Zacks Pro platforms. This is the second webinar in the new 2021 ECP Family Series. The first webinar can be found on our channel. That's from last week. If you would like to do the kind of analysis you're going to see in this video, then you'll need to have a ZAT Portfolio Manager subscription, which includes both Zacks Advisor Tools and the Zacks Research System. Today, I'll be using Zacks Advisor Tools to showcase some of the new sector allocation reporting capabilities and the Zacks Research System with Composites to look at the variability, the valuation, and the profitability trends. Now let's go ahead and get started. After you see this webinar, I want you to ask yourself, is your current equity investment process this easy for you and your clients to understand? And go ahead and leave your comments below. The first thing we need to do is have an understanding of why we need an earnings stable core equity portfolio. And just a quick aside and story that happened back at the end of 2019, we did a fourth quarter strategy call that we normally do once a quarter. And I was on the call and had made the observation that the 2-year Treasury yield had been rising into the 10-year, and then it was actually on the downward trend. And this particular observation has successfully preceded each of the past 7 recessions. And so I warned in that strategy call that we needed to begin preparing, and I floated the idea of starting to mirror this concept of an earnings certain portfolio. And to my surprise, and I would have never guessed it would have been triggered by a global pandemic, we actually did end up in a recession. So the idea here is that we need to have an earnings stable core equity portfolio because you're not necessarily going to get tipped off from sell-side research firm as to when the actual recessions are going to hit, and you're certainly not going to be able to predict black swan events. So the idea is to understand the sectors themselves that lead the S&P 500 into the abyss during recessions. And I actually have a screen capture that I borrowed from a webinar that I did on the earnings certain portfolio a year ago during the COVID crisis that outlines this phenomenon exactly. So these particular sectors are the consistent laggards of the S&P 500 during recessions and black swan events and most large corrections. So we've got the IVV up here, which is the S&P 500 ETF. The utilities is kind of hit and miss. You can see that it was just a slight underperformer. But then when you start going down to real estate, and from this particular time frame, it was a February 20th time frame to roughly the end of April or so. Real estate had already lagged 20%. Financials were down 29%. Energy was down 35%. Obviously, they went from a maximum trough of much greater than that, but they were already on the rebound at that point. So again, these are the sectors that were dragging the S&P 500 down. They continued to be a lag on the S&P 500 for some time. And the point is these are the sectors that you do not want sitting in your core position and your core equity position long term. It's okay to tilt in with these sectors, but these are the sectors that can lead you into real trouble with a long-term buy and hold strategy. Notice that these sectors have never been present in the Zacks earnings certain portfolio. The next slide, these are the sectors that actually lead the S&P 500 during recessions, and you can see that we've got the healthcare. You can see the S&P 500 here, the IVV. Leading the charge here is healthcare, consumer staples, consumer discretionary, IT, telecommunication services, and then materials, a little bit of a laggard, and the industrial sector, obviously a laggard. I put those two sectors in this particular slide because with regard to materials and industrials, the Zacks earnings certain portfolio eliminates the cyclical names in those sectors, and we favor only the earnings stable names. So within the industrials and within the material sectors, you can find some real nuggets of gold with regard to companies that have demonstrated 20 plus years of rock solid earnings stability. So again, the idea is to eliminate the high volatility and the low earnings stability out of the S&P 500. And the next chart that you'll see here is the S&P 500 composite out of the research system, showing the price in blue and the operating earnings line here in orange. This is just a trailing 4 quarters adjusted EPS that you're seeing here in orange. And the idea, again, is just to look at the volatility and price, look at what you're dragging your clients' assets through, that capital loss, that principal loss through these recessionary cycles, only to attempt to get it back many years later, and then having the same recession hit again, and you literally just give up decades worth of returns. And that's what happens with the S&P 500, okay? The earnings certain portfolio is obviously a lot different, right? This is low volatility, high EPS stability. So much different scenario. You can see earnings literally just continue to grow almost virtually unscathed through every recession. And you can see that that price just continues to march higher and higher and higher as those earnings continue to grow, anywhere between a 9 to 11.5% or so interest rate or growth rate each year. So the idea here is that we've got 6 points that I want you to remember related to the earnings certain core 75 stock portfolio. This portfolio, obviously from last week's webinar, you recall the distillation process, very, very disciplined portfolio. It is literally 75 of the most legendary, mature, dividend aristocratic, most of them do pay a dividend, industrial names. And if you look at them as a portfolio, their earnings growth and their stability stands the test of time. And that's what I've been showing you in that price and earnings chart. These are companies that provide goods and services that we all use every single day. But most of you as advisors, and certainly all of your clients, most of them have really never heard of a lot of these companies. That's the irony behind this portfolio. You use them every day and you don't even know who they are. Keep in mind that, again, the financials, energy, real estate, utilities, commodities names, precious metals, and all those other economically sensitive names that I mentioned in materials in the industrial space, those are not present in the earnings certain core 75 stock portfolio. You're also going to find something very interesting. You've seen a lot of the performance numbers. We're going to dive into the risk metrics here in just a minute. But Apple, Facebook, Microsoft, Netflix, Amazon, Google, Tesla, these are all names that are not present in core. There are no IPOs, no pot stocks, no other, trends or flavors of the day. Again, we're looking for 20 years of rock solid history. It's going to take quite a bit for Tesla to end up in core. Okay, it's going to take many, many years. So the key here, and you'll see here in just a minute why this is so important, is that you've got to manage the long-term macro tilts and the short-term tactical tilts to manage beta exposure and upside capture. So we're going to dive into point number 5 here in just a minute. The idea here is that this is a really, really easy to follow strategy, and certainly one that your clients will be comfortable with and understand. And last and most important here is that this is a strategy that you really can call your own. So let's take a look at what this looks like from a risk perspective. And we're going to focus on the core ECP 75 stock portfolio with no tilts at all. So no macro tilt, no tactical tilt. Okay. So you can see that we've got the difference between the portfolio and the benchmark here. All the numbers in green are obviously better. The numbers in red are the ones that we manage to actively. Okay. So standard deviation obviously lower, beta of 0.77 with an R squared of 0.87. So that R squared is interesting because we are getting a lot less risk with a beta of 0.77, but the R squared is telling us the amount of return that can actually be attributed to changes in the benchmark itself. So it's very, very correlated to the S&P 500, but with a lot less risk. And we can actually measure the risk in terms of return per unit of risk by looking at the Sharpe ratio. And you can see that the Sharpe ratio per unit of risk adds about a 38 basis point difference. So 1.05 versus a 0.68. That is absolutely tremendous. That is a huge improvement, roughly about a 33% improvement. You can see the value at risk is actually much less as well. Maximum drawdown is lower by 22%. Annual turnover is only 8%. Okay. So when we ran the the actual performance over that 180-month time period, which is roughly 15 years, you can see that the all market annual return for the portfolio is 13.2%. Benchmark return is about 10.29. So we've got an overall cumulative excess return of 2.91. The upmarket annual returns registered in at about 123 months. We actually lagged, and this is one of the things that we managed to. Okay, that's why I have it here in red. Down market returns, we outperformed to the tune of almost 12%. Again, speaking to that defensive nature, right? That beta of 0.77 and that return per unit of risk, much lower risk with higher returns per unit of risk. So the idea here is that all markets, we have a 54% win rate overall. Up markets, which occurred 48 months, 39% win rate. Down markets, 49, 86%. Okay. So the idea here is that in down markets, we absolutely clobber the benchmark. We win 86% of the time. And again, the key is to manage that beta exposure with tilts to ensure that we get that upside capture. So we're going to talk about how we're going to do that. And keep in mind, in the next couple of weeks, I'm going to be having a dedicated tilt webinar. So I'm not going to dive too much into tilting strategies on this particular webinar, but we will follow up in detail on what these macro tilts are in about 2 to 3 weeks. So now we're going to actually compare the core ECP 75 stock strategy to the core ECP 75 stock strategy when you apply a 30% macro tilt. So there's basically 6 stocks that we've been using as a macro tilt since 2012. The same 6 stocks, you basically apply 30% of your equity assets in that basket, 70% of the remaining in the ECP 75 stock basket. So if it was $1 million, you'd put 300,000 in the macro tilt, 700,000 in your ECP 75. These are your 15-year metrics from a risk perspective. So again, much lower standard deviation. Sharp ratio gets even better, almost double, 1.21 compared to 0.68. Beta ticks up just a little bit. R squared pretty much stays the same. So the overall trend and ability for the benchmark to basically explain the movement in the underlying portfolio is still intact. Value at risk is still lower, which is great. Max drawdown still 15% less. Annual turnover still 8%. But you can see that the difference in your all market annual return over those 180 months is now an excess return of 7% versus 2.91. And then we manage that upmarket annual return for those 123 periods. That excess return now goes positive 4.25. So all we're doing is we're bringing that beta up from 0.77 to 0.89. When we do that, we increase our Sharpe ratio. We do it smart. We will talk about this in a couple weeks, how we do this. But you can see that the results here speak for themselves. Down market returns, 8.66, still spectacular. Win rate, absolutely spectacular, right? All market, 68, up market, 65, down market, 75. So really, really solid performance, okay? Earnings certain core 75 stock composite versus the S&P 500 index. Again, the performance, what does this all mean? We spoke about this last week. I won't dig into it too much, but again, it's all about protecting those client assets during those turbulent times. And you can see how much of the returns are given up by the S&P 500 every time we go through a recession. You're giving up literally 5 to 10 years worth of returns. We did this all through the early 2000s. And while the earnings certain portfolio just continued to perform. During the Great Recession, it only took 2 years to recoup our losses versus a little bit over 5 years for the S&P 500. During the COVID era, you could see that every time we had a downturn, the earnings certain portfolio outperformed the S&P 500. And those returns just continue to compound year after year after year, which gives us that stellar performance. So why does this work, you ask yourself? So the idea is, in order for you to understand this, you've got to look at the price and earnings of some of these stocks that are in the S&P 500 that we are not exposing ourselves to in our earnings certain core. So you've all seen the pictures, you're going to see them here again, of the earnings certain stocks where the orange earnings line is just a straight arrow. When you can see Ford Motor Company here, look at the earnings variability or the cyclicality in Ford Motor Company. And if you've been an investor in Ford since the end of 2010 or 2014, if you held it from 10 to 14, you were dead money. And even though Ford is just the talk of the town, it's in every newspaper, it's all over CNBC, that's all we talk about is Ford and GM. you're still dead in the water. If you've been holding this thing since 2010 to 2014, you're still negative. So the idea here is that you look at these cyclical names, and over time, many of them are just broken and they're just not performing. Same thing with Schlumberger. You'll see a lot more trends in energy here as we go through some of these valuation profitability type slides here in just a minute. But if you've been holding Schlumberger since the Great Recession, you're still negative. Even if you bought it during the run-up of 2012, 2013, 2014, you're still negative despite all the excitement with the rotation and the economic recovery. You can see how far you're still down. So when you compare this to the representative stocks and the earnings certain Core 75, again, I mentioned that a lot of these companies, you use their products every day, but you don't realize who they are. When you look at the earnings line for a company like Church & Dwight and you show this to your clients, the first response is, well, of course we would be invested in that. I mean, why not? Because if you bought it in 14, you're still up. If you bought it in 10, you're still up. If you bought it in 8, you're up. If you bought it any time here when the S&P 500 gave up decades of return, you're still up. This stock continues to grow at that same trajectory. So what are the odds it's going to continue to increase in price? It's a pretty easy concept for clients to understand. Church & Dwight makes Arm & Hammer baking soda and Trojan condoms. So it's not like any of that's going to go out of style anytime soon, and clients can certainly relate to that. McCormick & Company, you know them well, spices, did a tremendous job during COVID. Obviously, restaurant demand took a bath, but everybody was cooking at home during COVID. They actually grew earnings again through the recession. They do this every time. Interestingly enough, when McCormick is selling spices to restaurants in bulk, those are lower margin SKUs than the ones that are in the grocery stores. So McCormick tends to do better in that regard anyway. So why not hold a company like McCormick? Okay. When we start looking at the profitability metrics of these companies relative to the S&P 500 and relative to other companies that we avoid out of the S&P 500, you'll see some astounding differences. So just hold on to your chair. When you look at return on assets for the earnings certain portfolio overall versus the S&P 500, it's more than double. This is literally the ability to compound the return on the assets sitting on the corporate balance sheets on average. Is basically twice as efficient for an earnings certain stock than it is for the average S&P 500 company. And then you take a look at individual names. Look at McCormick's ability to compound return on its balance sheet, on its assets relative to JP Morgan. And again, nature of the business, fine. It's just a business I don't have to be in all the time. I can tilt into JP Morgan and financials when the time is right, when the economic cycle and the yield curve dictates that the time is right. I don't need to sit in it. You're only looking at a return on assets of 1.2% when I can be in McCormick earning 7% return on assets. Just some other ones that are interesting. Church & Dwight, we talked about. Ford, we obviously know. Return on assets for Ford, obviously very capital intensive, very low return on assets at 2.32. Church & Dwight at 9.9. This isn't a 1 quarter, 1 year anomaly. This is for the last 15, 20 years. Same thing with Fastenal versus Caterpillar, right? Industrial versus industrial. Do we want to play around with cyclicals and hold them for 15 to 20 years in core, or do we want to just tilt in when Caterpillar is right for a recovery? No, we want to hold companies like Fastenal that have a 20% return on assets versus holding Caterpillar at 5% over the long term. Okay, Caterpillar has a time and a place. It belongs in a short-term tactical tilt. Okay, return on equity, ability to compound return on common equity. We look at the earnings certain portfolio relative to the S&P 500. It's an outperformer, not just a 1-2 quarter phenomenon, but throughout its history. Okay, this is the trend. We take a look at individual companies like Expediter versus Schlumberger. The interesting thing I want you to note here is this is return on equity. So this is basically the ability to compound the return on the actual common equity investment. 33% returns for common equity shareholders versus Schlumberger at 7.2. The next slide gets really interesting because we're going to look at return on capital. And this is the ability to compound return on total capital. And you can see 14.99 versus the S&P 500 at 11.72. But what's interesting is Expeditors stayed the same at 33.74, and Schlumberger was cut in half. So I'm going to go back one slide. You can see Expediter at 3.374, Schlumberger at 7.2. That's return on equity. And you can tell that Expeditors has no debt because that's why their return on capital stayed the same. Schlumberger got cut in half because they've got half their capital structure roughly in debt. And so that metric drops. So it's a wonderful thing being able to read these profitability metrics like tea leaves. You can almost get a really good understanding of what's going on the balance sheet just by comparing these values against one another. And that's what I like to do. When you look at free cash flow, return on invested capital, again, just the general ability for these companies to be able to generate cash. I like to consider this kind of like an operational efficiency type ratio, ability to generate cash. Earning certain portfolio stocks, again, reign supreme. You can see these guys are moving in completely the opposite direction right now. Earning certain versus the SP5, it's about a 70% better ratio for the average earning certain stock. And if you look at the reason why, obviously we tilt away from ExxonMobil and Core. Okay to hold a company like Exxon in your short-term tactical tilt, but we don't sit on that company for 15, 20 years. There's a time and a place for Exxon. The time and place is actually now. It wasn't obviously during the Great Recession, nor was it the time during the last recession, the COVID recession. But you can see that from a free cash flow perspective, we're talking orders of magnitude difference between ADP, who's just been on a constant uptrend, versus ExxonMobil, who appears to be more on a broken trend in terms of their ability to generate free cash flow. Okay, so the idea here is that earning certain stocks, they do trade at a premium. I want everybody to know that. When you do valuation analysis work, it's always a good idea to have the 75 stock names in front of you. That way, when they come up on a screen or they come up in a quant score and you're saying, wow, that looks expensive, there's a reason. You're paying for the quality. They've always traded at a premium. It's no surprise. So the way to look at this is relative to how they're trading relative to their 5-year median versus the S&P 500. And right now, that valuation is currently in line. So the median over 5 years is about a 1.1 relative to the SP5. So it normally trades at a 10% premium. That's what that's telling you, 1.10. So that's a 10% premium over the S&P 500. Currently trading at a 15% premium. It's high. It's been up as high as a 26% premium, and it goes about as low as a 5% premium. So the lowest it's been in 5 years is a 5% premium. You're paying about a 15% premium right now, a little bit above its median of a 10% premium, but still a valuation that's well in line given the uncertainties out there. So implementing the earning certain 75 stock portfolio, there's many different strategies. We have a new support model that we're rolling out that we will actually sit down with you and do the review with you and discuss these various strategies. But it's very simple. We like that you choose your ECP core strategy, so that we've got 3 of those. We've got the core 75 that we're reviewing today. Next week, we're going to go over the core 30 Admiral, and the week after that, we're going to go over the core 25 Dividend Aristocrat strategy as your core. But in this particular strategy, I just like to use a 70% weight as a baseline just to get started. We apply the macro tilts. Again, there's 6 stocks. They've been the same 6 stocks since 2012. And all we're doing is we're combining that macro tilt so that we can get that technology sector and communication services sector as close to the weight of the S&P 500 as possible. And then the step 3 here, depending upon where we're at in the economic cycle, those weights will generally be anywhere between 0 and 35%. You're going to literally tilt into those financials, those energy, those real estate names, and you're going to use the offsetting weight from core. And in some cases, if you're getting into semiconductors or you're getting into additional tech names, then you'd want to take a little bit of a tilt out of the macro. But at any rate, very, very easy to kind of move in between that. And the next slide I'm showing you here is just 3 sample allocations for optimizing this and just showing you how long you have to respond to these changes in the economic cycle. And it's very, very easy to read this, and it's something that we can do together in this new support model. So I call it the 3 stages recession preparation. That's what I called back in December 2019. When you start to see that 2-year treasury converging into the 10-year, you want to start paying attention to the ISM numbers, leading economic indicators, other things at that point. But traditionally speaking, it's a good idea to prepare for 12 to 18 months ahead of time to begin thinking about the fact that we could be going into a recession. At that rate, you want to start rolling your ECP core to about 70%, your macro long-term tilt to 30, and you want to start unwinding those tactical tilts. Those are the names that will get you into real trouble if you hold them into a recession. So those are your financials, your energies, those types of names. When we start coming out of a recession or a black swan event, you've got about 3 to 6 months to execute on this. You're going to basically begin to taper back your defensive position, your core 75 stock portfolio to around a 45% weight. So you just do this over time. You rein in your macro long-term tilt from about 30% down to 25, and then you bring up that short-term tactical tilt to kind of take advantage of that recovery in the economy, the recovery in the business cycle. So start to fold into some financial names, start to fold into some energy names. And then once we get into what I call just the normalized earnings growth phase of an economic cycle, this is obviously where we're just, in the smoother waters. We're not in a recession. We're not necessarily just coming out of a recession. You've got a couple of years to put this on. ECP Core 75 stock portfolio goes to about 50%. You ratchet up the macro long-term tilt back to 30%. And then you bring your tactical short-term economic cycle tilt to about 20%. So we'll talk more about this. But what I wanted to kind of show you is what these allocations look like in Core. So you can see here in the new portfolio report builder and the Zacks Advisor Tools platform, I've got the ECP Core 75 up here versus the S&P 500. And you can see the energy sector here, the weight in the portfolio is 0. You can see financials, I've only got one name in here. It's one name that I love that I don't consider a financial, S&P does. And that's fine. It's an earnings certain name, whether it's a financial or not. So consider it 0. And utilities 0 and real estate 0. And so again, we start with a 30% ECP 6 stock long-term tilt to bring that technology and communications sectors up to the S&P 500. So you can see that we're way underweight in Core, the IT sector and communication services. And that tends to be why we lag in those up markets. So these two boxes in green are what we manage to with the macro tilts, okay? Now what we do after we've applied those macro tilts, so with a 30% macro tilt, you'll bring your information technology almost up to even with the S&P 500. Communication services does go to even. These are weights as of, I believe, April 1st that I'm using in these model portfolios. So they will differ, and the idea is you're going to be somewhere between 30 and 35% on the macro tilt to get that information technology sector weight up. However, keep in mind that as you're using ETFs or stocks to apply the short-term tactical tilts to get exposure to energy, financials, utilities, and real estate, you're going to remove those offsetting weights from Core, and you may end up adding a little bit of tech naturally there. So again, they're not steadfast, hard guidelines. They're just general guidelines. Start out with a 70% ECP, go to a 30% macro tilt, calculate your weights based on current pricing, and then figure out what you're going to do with those short-term tactical tilts. And then again, most of the time, you're going to remove those offsetting weights from Core. So if you decide you're going to do a 20% short-term tactical tilt, you're going to pull 20% away from your ECP Core. So it's going to go from 70 down to 50. Very, very easy, and these are things that we can discuss. If you've got any questions, you can always give me a call. Earning certain family of portfolios, how to become a client. Most advisor tool subscription levels offer them as a premium add-on. For the premium professional subscriptions, they can be included at that price level. You just have to choose it. And then for ZAT Portfolio Manager, it's included with the base services. That's the service that I've more or less demoed today, and it also includes the research system. Zacks Research System gives you the ability to visually model all of the earnings certain family on the graphics. You've seen it with the price and earnings charts. You've seen me utilize it with financial statements and the profitability charts that we just looked at. And then I did mention that we're rolling out that ECP Premium Support. It's available for an additional fee. And again, this is for anyone who wants to do a deeper dive and understand how best to utilize the ECP tilts, both the macro tilts and the tactical tilts with your existing strategy. So be sure to join me next week. We're going to continue on with the ECP 30 stock Admiral Core, And we're going to look at, again, sector allocation with and without tilts. We're going to look at the risk return characteristics and again, dive deeper into what makes that ECP 30 Admiral Core portfolio so successful. Remember to ask yourself if your current equity investment process is this easy for you and your clients to understand. Go ahead and leave us your comments on our YouTube channel. That's about it for this week. If you found this video helpful, please hit the like button below and be sure to subscribe for future videos. If you have any questions or ideas for future videos, please leave a comment below or email me at tnyland@zacks.com. You can also follow me on social media. I'm on LinkedIn. I'm also on Twitter at Tim Nyland. If you'd like a copy of my slide deck, I make these available to anyone who sends us an inquiry. Those inquiries can be emailed to any of the addresses that you see here on the screen. If you're interested in getting started with Advisor Tools or the Zacks Research System, or if you're looking to upgrade your current subscription, just contact our world-class support at advisortools@zacks.com and zrs@zacks.com. Thank you for watching, and I'll talk to you next week.